Hello everybody. Ever wondered what stocks options are and what the benefits of trading options are as opposed to simply trading stock? Let's keep learning options, trading basics and why people trade them. You'll learn each concept with visualization to help you understand option logically. Options trading is the act of buying, selling a stock's option contracts in an attempt to profit from the stock's future price movements. Traders can use options to profit from stocks price increases, bullish trades, decreases, bearish trades, or even when a stock's price remains in a specific range over time, neutral trades. The benefits of trading options instead of shares of stocks are leverage. With options, traders can leverage return potential, which means significant gains can be made with relatively small amount of money. For example, an options trader can risk $500 and make $500, so 100% return on investment, if their stock price prediction is correct. When buying shares of stocks, the stock price must increase 100% for you to double your investment. However, there is also the potential to lose money compared to trading shares of stock. Leverage can work for you or against you, but when used carefully, it can increase returns on investment immensely. Another huge benefit of trading options is that the strategies used can sometimes have significantly less loss potential compared to buying, shorting shares of stock. As mentioned earlier, options can be used to profit from virtually any stock price movement or lack of in the future. Before getting to the specific details related to options, we need to first cover the unique characteristics of option contracts. All options have expiration dates, which is the date the option's final value is determined and can no longer be traded. Stocks typically have options with expiration dates ranging from a few days to 2 years away. An option strike price is the price at which shares will be bought, sold if an option is expired. We'll talk more about this in a moment. Contract multiplier. The number of shares an option contract can be converted into. Typically, equity options like Apple options have a contract multiplier of 100. Each option can be converted into 100 shares of stock. Our first trade example will demonstrate how options can leverage returns compared to simply buying shares of stock. As we can see, the option trade resulted in a much more significant returns relative to the money invested. However, if the stock price remained at 150 over the 30 days period, the stock trader would not have lost any money, while the options trader would have lost the entire 500 investment. If you're wondering, buying a $5 option cost $500 because of option contract multiplier of 100. The $5 option price is on a per share basis. which means the actual cost of the option is 100 multiplier more than the option's displayed price. Now that you have seen the power of options, let's get into the two option types. The first option type is a call option. Gives buyers the right to buy 100 shares of stock per contract at the option strike price before the option expires. Here are some examples of what this means. Since there is more value in having the ability to buy shares of stock at low price, call options will lower strike prices, cost more money. Additionally, call options at lower strike price have a higher probability of being available at expiration, as call options only have value at expiration if the stock price is above the call's strike price at the time of expiration date. To make sure call options make complete sense to you, let's look at hypothetical trade example to demonstrate the profit-loss potential when buying a call option. At 50 or less, at or below the call strike price, the option will be worthless at expiration because there is no value in being able to buy shares of stock at 50 with a call option when the stock price is at or below 50. At 55, the call option is worth 5 at expiration because the ability to buy shares of stock 5 below the current share price is worth $5 per share. At 60, the call option is worth $10 at expiration because the ability to buy shares of stock $10 below the current share price is worth $10 share. At 65, the call option is worth 15 at expiration because the ability to buy shares of stock 15 below the current share price is worth $15 share. Compared to buying shares of stock, buying call option can have significantly less loss potential when the stock price falls substantially. However, for the call option to break even or profit, the stock price must increase. Clearly, as a call buyer, you want the stock price to increase as much as above the strike price, as the call's ability to buy shares at a discount to the current share price will become more valuable, meaning the call option's price will increase. Just like shares of stock, call option can also be sold at any option trade. For instance, let's say a stock is trading for $100 and we sell the 110 call for $5. When selling call options, as long as the stock price is below the call strike price at expiration, the position will be profitable. However, if the stock price rises substantially, the loss potential on a short call position is theoretically unlimited. Here's how this particular short call position will perform based on various stock price at expiration. For instance, if the stock price rose to 200 by the call's expiration date, the loss will be 8,500 per call that was sold. With the stock at 200, the 110 call will be worth $90 because the ability to buy shares $90 below the current share price is worth $90 share. Since the call was sold for $5, the loss will be $85 on the option, which represents an $8,500 loss per contract due to the option contract multiplier of 100. At 115, the call will be worth $505 and there will be no profits or losses. At 110 or lower, the 110 call would expire worthless and the call seller would keep the 500 collected when initially selling the call. Because of the rise outlined above, it's not advised to sell call options without protection in the form of long stocks or another call option purchased against the stock call. The second option type is called a put option. Gives buyers the right to sell 100 shares of stock per contract at the option strike price before the option expires. Here are some examples of what this means. Since there is more value in having the ability to sell shares of stocks at higher price, put options will higher strike price cost more money. Additionally, put options at higher strike price have a higher probability of being valuable at expiration, as put options only have value at expiration if the stock price is below the put's strike price at the time of expiration date. Like we did with calls, let's go through a hypothetical put option trade example. At 200 or higher, at or above the put strike price, the option will be worthless at expiration because there is no value in being able to sell shares of stock at 200 with the put option when the stock price is at or above 200. At $195, the put option is worth $5 at expiration because the ability to sell shares of stock $5 above the current share price is worth $5 share. At 190, the put option is worth $10 at expiration because the ability to sell shares of stock $10 above the current share price is worth $10 share. At $175, the put option is worth $25 at expiration because the ability to sell shares of stock $25 above the current share price is worth $25 share. Compared to shorting shares of stock, buying put options can have significantly less loss potential when the stock price increases substantially. However, for the put option to break or even a profit, the stock price must fall. Just like calls, put options can also be sold. For instance, here's how selling a put would work out if we sold a 170 put for $7 on a stock that was trading for $190. Sorry. As long as the stock price is above the put strike price at expiration, the position will release a full profit at 100% of the option premium called when the selling the put will be kept. The reason for that is the put will be worthless because there is no value in the ability to sell shares at a price below the current share price. However, if the share price falls, selling put option call result in significant loss potential. For example, if the stock price fell to 150 by expiration, the 170 put would be worth $20 because there is $20 per share value is being able to sell shares 20 above the current stock price. Since the put was sold for $7, an increase to $20 would represent a 1,300 loss per put contract that was sold. The worst case scenario when the selling put is that the stock price falls to zero. The company goes out of business before the option expires. And in the end, if you want to get a professional course of trading in options, we resell SMB options courses. As you see, for more details, message me on my email and we'll discuss how to get this course. Of course, I'll give you a link if you want, and you will have very great course. Goodbye guys, and have a good trades.